Welcome to the deep dive. Ever looked at a chart, seen a massive price jump, and thought, wow, high momentum.
Mm,
But then the next day, you get completely whipsawed.
happens all the time.
Yeah, well, you've probably stumbled into like the biggest conceptual pothole in trading,
hmm
mixing up momentum and volatility.
Absolutely. We tend to use them almost interchangeably in casual talk.
Right. But doing that, it really damages your risk management. It's not just splitting hairs.
No, definitely not. This distinction isn't academic at all. It's really the bedrock for building solid trading strategies.
Mhm.
Effective risk management, and honestly, just better market intuition.
Okay.
Momentum and volatility, they describe fundamentally different things about price action, getting them confused. Well, it's like trying to drive by mixing up the gas pedal and the steering wheel.
That's a great analogy. So our mission today is to go beyond just the textbook definitions.
Right.
We're going to deconstruct both concepts. We'll show you exactly how you can measure them and, crucially, analyze how they interact.
And why that interaction matters so much.
Exactly. By the end of this deep dive, the goal is you'll stop seeing just confusing noise on the chart and you'll start isolating a clearer signal.
Sounds good. Let's maybe start with the signal itself, the engine driving the price.
Okay, momentum. When we talk about momentum in markets, we're basically borrowing from physics, right? It's like inertia.
It really is.
Yeah.
It's almost a direct application of Newton's first law. An asset's price trend, once it's going, tends to stay in motion unless, something significant pushes against it.
Some external force acts on it.
Exactly. So technically, we define momentum as a directed force. It's a vector quantity,
Meaning?
meaning it has both magnitude or speed and direction. It measures how strongly a price is moving and, critically, in which direction it's moving over a certain time period.
Got it. And the why behind strong momentum, that's really about market psychology, isn't it? Pure urgency.
Totally. When you see strong bullish momentum, what you're actually seeing is buyers just aggressively and consistently overwhelming sellers.
Like a stampede.
Sort of, yeah. And what the sources often point to is that this urgency is fueled by FOMO, the fear of missing out.
Ah, FOMO. Classic.
Right. And that leads to these rapid, almost frictionless price jumps with really shallow pullbacks.
And presumably the opposite for strong bearish momentum. Just panic selling taking over.
Precisely. Panicked selling that just crushes any attempt to find a floor. But maybe the single most vital concept for listeners here is spotting fading momentum, deceleration.
Great. So the trend is still going up, maybe, but it's losing steam.
Exactly. That fading momentum is like an internal alarm bell.
Right.
It signals that the dominant force, whether it's the buyers or the sellers, is starting to get tired, exhausted. The trend is losing its fuel, even if the price is still inching a bit higher or lower.
So it's not a reversal signal on its own necessarily?
Not necessarily a reversal yet, but it's a huge warning sign. The trend is weakening from the inside out. You need to pay attention.
Okay, so how do we actually, measure this? Get a read on this directed force?
Right.
We use indicators, right? Oscillators.
Yeah, we use specialized tools. The classic one, everyone knows, is the RSI, the Relative Strength Index.
Right, 0 to 100 scale.
Yep. It measures speed and change. Now, a lot of people just use it for simple overbought, say above 70 or oversold, below 30 readings.
Mm-hmm.
But you need to understand why those levels matter. They're really just manifestations of momentum that's become too stretched. It's likely exhausted at those extremes.
Gotcha. Makes sense. What else?
Then there's the MACD, moving average convergence divergence.
Okay.
Now, the steepness of the MACD lines themselves, that gives you a good visual cue about momentum. But the real gold, I think, is in divergence.
Divergence, explain that.
Okay, so imagine the price of an asset hits a brand new high, really pushing up.
Right.
But at the same time, the MACD indicator fails to make a corresponding new high. It makes lower high. That's divergence.
Okay. So the price is still going up, but the engine behind it, the momentum, isn't confirming that strength.
You nailed it. It's like a car coasting uphill on the last fumes of gas.
Oh.
The price is still moving, maybe, but the underlying momentum engine is sputtering.
And that's a powerful warning.
It's one of the most potent momentum-based reversal warnings you can find. So fundamentally, momentum traders are trend riders.
They're trying to stay with the force.
Exactly. They use these indicators not really to predict exact tops or bottoms, but to confirm the vitality of the current trend, to make sure they aren't riding a trend that's already dying internally.
Okay. That clarifies momentum as the signal, the force. Now let's pivot. Let's talk about the market's ambient environment, the noise where direction doesn't matter.
Right. So if momentum is the vector, The directed force volatility is the scalar.
Scalar meaning.
It has magnitude, size, but no specific direction. Think of it like the ambient energy, or maybe the temperature of the market. Just quantifies the noisiness.
Okay, so it's measuring how widely the price is swinging around its average, like using standard deviation.
Precisely. High volatility doesn't mean the price is going up strongly. It just means the price is making big, often erratic swings, but potentially in either direction. Up one day, down the next.
High energy, but zero directional commitment.
That's a perfect way to put it.
Yeah.
And the why behind volatility spikes, it's usually pretty simple. Uncertainty.
Uncertainty. Makes sense.
Volatility jumps when traders strongly disagree about what something is truly worth. This usually happens around surprises,
Like,
unexpected earnings reports, key economic data releases that miss expectations, sudden geopolitical tensions, maybe a central bank announcement that catches everyone off guard.
so it's the market basically expressing collective doubt or confusion.
Exactly. It's the physical manifestation of uncertainty.
And because volatility is fundamentally about risk and uncertainty, the tools we use to measure it are mainly risk management tools, right?
That's their primary function, and probably the most practical one for everyday trading is the average true range, or ATR.
ATR. Heard of it, but break it down.
Sure. The ATR is essentially just a dynamic measure. It calculates the average size of the trading range, the distance between the highs and low, adjusted for gaps over a specific period.
Okay, so it tells you how wide the price swings are on average right now.
Exactly. It tells you how noisy your market is currently. And this is absolutely crucial for setting realistic stop losses and even profit targets.
How so?
Well, your stops need to account for the market's current expected noise level. If the ATR is high, meaning the market is making big daily swings.
You need a wider stop loss.
Right. Otherwise, you'll just get stopped out by random noise, not because your trade idea was wrong.
So the implication for trading is huge here. Volatility isn't a strategy itself.
No, absolutely not.
It's a critical parameter for basically all strategies. And if the ATR, the noise level, is high, you have to adjust, right? You have to shrink your position size.
Inversely, yes. To keep your dollar risk the same per trade, you have to adapt your driving to the road conditions. High volatility means slippery roads. You slow down your size.
Good analogy again. Okay, what other volatility measures are useful?
Another really insightful one is Bollinger Bands.
Bands around a moving average.
Correct. Those bands are plotted a certain number of standard deviations away from a central moving average. They visually show you how far the price is deviating.
And what's the key insight there?
Well, besides seeing if price is hitting an extreme band, the really interesting thing is when the bands contract sharply. They squeeze together.
The Bollinger squeeze.
Yep. That squeeze means volatility is historically low, the market is quiet, consolidating, and very often these periods of low volatility precede a significant breakout. A big, high volatility move is often coiling up.
Like pressure building.
Exactly. And finally, there's the one most people hear about in the news. The VIX index. The CBOE Volatility Index.
The fear gauge.
That's the nickname. It's a bit different because it's forward-looking. It reflects the expected 30-day risk based on S&P 500 options prices.
So it's like a market barometer for overall investor anxiety.
That's a good way to think about it. It captures the market's collective guess about near-term choppiness.
Okay, this is crucial. We've defined momentum, the signal, and volatility, the noise. Now, how do they interact? Because this is where I think a lot of expensive mistakes happen. People confuse big swings, high volatility with a strong directed force, high momentum.
That's exactly right. Understanding the interplay helps you define the type of market environment you're in. And that's critical because, you wouldn't take a Formula One car onto a muddy dirt track.
Different tools for different conditions.
Precisely. You shouldn't force a trend-following strategy, which relies on momentum, into a market that's just chaotic, high-volatility chop with no direction.
Okay, let's break down the main combination. Scenario one, the ideal one for trend followers, right? High momentum plus low volatility. What does that look like?
Yeah, the dream trend. Visually, it's a smooth, persistent ramp upwards or downwards.
Nice and clean.
Very clean. The trend just keeps going with small, orderly pullbacks. There aren't big, scary swings against the trend.
And what does that tell us about the market psychology?
It signifies strong, confident consensus. One side, buyers or sellers, is firmly in control, and there's very little opposition or uncertainty. It's the most efficient, least stressful environment for a trend follower because the signal is strong and the noise is low. It's almost frictionless movement.
Okay, dream scenario. Now, the nightmare scenario, probably the one that costs traders the most money. Scenario 2, high volatility but no clear momentum.
Ah, the chaotic chop, or the whipsaw machine.
Yeah. What's the look here?
Visually, it's just a mess. Huge, wild, jagged swings up and down, big range days. But the key is, after all that violent movement, maybe over a week or two, the market is basically right back where it started.
So lots of action, no progress.
Exactly. No net directional progress.
Yeah.
This is the market as a battlefield. Fierce clashes between buyers and sellers, often driven by conflicting news, headlines, pure emotion.
Why is this so dangerous for trend followers?
Because the high noise level, the high volatility, constantly triggers your stops. You get stopped out on the way down, then stopped out on the way back up. Constant whipsaws. It just grinds your account down.
Brutal. Okay, final scenario. The really exciting but maybe dangerous one. Scenario 3, high momentum plus high volatility.
Right, the climax run, or the parabolic move.
What does this look like?
This is where the price just rockets up or crashes down violently. Think Bitcoin in late 2017, or maybe a panic crash. Massive daily trading ranges, huge volume.
It feels like pure emotion.
It is. The sources consistently show this is typically the final emotional stage of a trend. It's fueled by the last wave of buyers piling in out of euphoria, FOMO again, or the last wave of sellers capitulating in panic.
So while it's moving fast in one direction, high momentum, the giant swings, high volatility, make it risky.
Extremely risky. And critically, these moves are almost always unsustainable. They burn out quickly because the market has basically exhausted all its collective energy in that one direction. They usually end in a swift, sharp reversal.
Okay, so we've got the signal, momentum, we've got the noise, volatility, and we see how they combine in different market types. The sophisticated trader, then, doesn't just focus on one, right? They have to synthesize them.
Absolutely. You don't choose between them, you integrate them, you use them together.
So what are the actionable takeaways for the listener? How do you actually combine these concepts into a better trading approach?
I think the key is to assign them distinct roles in your process. Volatility needs to provide the context and the setup. Momentum needs to provide the timing and the direction.
Okay, break that down. Actionable point 1, use volatility for context and setup.
Yeah. Look for those periods of low volatility we talked about, the Bollinger squeezes, those tight consolidations.
Because they often precede breakouts.
Exactly. Volatility, specifically low volatility, can tell you when a potentially significant move might be setting up, loading its spring.
Okay, volatility sets the stage. Then, actionable point 2, use momentum for timing and direction.
Right. So once price breaks out of that tight, low volatility range, you immediately need to check the momentum indicators. Use something like the MACD or RSI.
To confirm the breakout has power behind it.
Precisely. Does this breakout have real fuel, real force? Is the momentum confirming the move? Or is it a weak breakout likely to fail, a false start? Momentum answers that question. It provides the trigger and confirms direction.
Got it. Context from volatility, confirmation from momentum, and actionable point 3, maybe the most crucial for staying in the game, use volatility for risk management.
This is non-negotiable, I'd say. You must use a measure like the ATR, the average true range, to determine where you place your stop losses.
Why specifically ATR?
Because it dynamically adapts to the market's current noise level. Using the ATR ensures your stop is placed wide enough to account for the market's normal, expected daily fluctuations, its current noise.
So you don't get knocked out randomly.
Exactly. It protects you from getting stopped out simply because the market had a slightly wider random swing than usual. It keeps you in trades that are actually working, based on the signal, not the noise.
That makes perfect sense. So boiling it all down.
The core distinction, distilled, is this. Momentum tells you the strength of the signal. Where is the market trying to go, and how forcefully is it pushing?
And volatility.
Volatility tells you the level of the noise, how uncertain, how choppy, how unpredictable is the journey likely to be right now. #date outro.
Understanding that difference, really mastering it, lets you stop just reacting to every price wiggle. You start to understand the underlying dynamics, the force versus the uncertainty. And that leads to smarter, much more disciplined, and ultimately, I think, more durable trading decisions over the long run.
Well said. And maybe that leads to a final provocative thought for you, the listener, to sort of mull over.
Okay.
We talked about that climax run, scenario 3, high momentum and high volatility, often the final stage of a trend.
Right, the emotional peak.
Okay, so if high volatility is the market's fundamental expression of uncertainty, think about this. Does that volatility climax moment, paradoxically, represent the point where the market has actually achieved maximum collective certainty about the current price direction? Everyone is finally sure, rushing in together.
Huh. Maximum certainty right before the reversal.
Exactly. And as any experienced trader knows, when absolutely everyone in the market is collectively certain about something, the reversal is often already loaded and waiting just around the corner. Something to think about.
Definitely something to think about. Thanks for diving deep with us today.
My pleasure.
We'll catch you next time on The Deep Dive.